Greetings from Finstudyclub. My name is Ankur Kulshrestha, welcoming all viewers to the second session on inventory, where we will be talking about LIFO reserve. This is the term that you would have learned in your level 1 as well, but I think now is the time to really go into deep aspects about this. LIFO reserve, if you ask me, is sort of a hidden profit. Now, why do we call it as a hidden profit? Because it is generally not declared as a formal profit, by any LIFO firm. How do you hide it is something that we'll have to learn the flow of figures and the direction part of it. Now, what happens is, ceteris paribus, there are two firms. Let's assume one is the FIFO firm and the other one is the LIFO firm. Ceteris paribus, as in all purchases are from the same place, all sales are to the same place and to the same customer at the same price. Still, the LIFO firm is going to show a lower profit. Now, you must be wondering, if all the cash flows are same, cash payment to suppliers and cash collection from customer, why should the profit be different? The answer to that is in the accounting aspect, wherein if the prices are rising, now obviously in my previous session I had talked about to note the price trend very carefully as the most important point before answering any question about inventory. So this entire phenomena is in case of inflation only. So I'm assuming that the price trend is going up. If that's so, then the latest purchase comes at a higher price. My LIFO company would show that as an expense, so therefore the expense is more, therefore the profit tend to be lower. Obviously, I'm not talking about the tax aspect, and my focus is here profit before tax. Another aspect is that this equation, opening plus purchase is equal to consumption plus closing, also need to be understood as an application, and we have said that O plus P, the left hand side, remains fixed. So a LIFO firm which shows a higher COGS ought to show a lower closing stock. So therefore the same amount is what is the understatement of its inventory value. Now, this is really a phenomena that we have learned in level 1 as well, but what is the implication of that is what we are going to look at through this table. If we assume that there is a company, there are two companies which starts its business in year 1, which is the this yellow highlighted, and second is the year 2, which is blue highlighted. So we basically get to a point that out of a purchase of 30 and 35, the FIFO firm will show $30 as the COGS, whereas a LIFO firm will show $35 as COGS. So you see that COGS is higher by 5. That's exactly the same amount by which profit before tax is lower by. Now, this portion of 5 is hidden in form of inventory. If you look at it, LIFO inventory is understated by 5. Let's just continue this example and see that in the second year as well, there is an extra amount of delta 2 which is being shown as a higher COGS by the LIFO firm. So overall, if you look at it, the delta 5 plus delta 2 is resulting into a total hidden profit of 7. Well, in a way, which we have learned in level 1 as well, that LIFO reserve is actually the difference between the inventory FIFO minus inventory LIFO. That was really a plain simple definition. The real application and objective of that is that it hides the profit which are there in your the inventory. Now the question is as to, let me just go back to the previous slide and complete that. LIFO reserve has a positive balance only in case of inflation, obviously, because in case of inflation the last purchase is going to be expensive and therefore COGS is going to be lower in case of LIFO. The entire analysis is going to reverse in case of deflation. Another very important aspect is that it exists only in the US where the LIFO method is allowed, because generally in IFRS we do not allow LIFO method. So the entire phenomena exists only in the US. And obviously from level 1 knowledge we know about the fact that LIFO is a very important link for conversion of one method to the other, which we are also going to talk about in my next video, which is the method change. So coming back to my table, and again a very important aspect, should I say the most important aspect of this session is, when would this hidden profit be realized? Would it be, kept hidden for the entire life of the company? Well, maybe yes. But let me take a hypothetical scenario and assume that in the third year, there is opening stock is 37 and 30 respectively. There is no purchase being done, and there is 1 unit of sale which is being done. Now, obviously, if I have only 1 unit of inventory, I will book it at 37, and I have only 1 unit of inventory, I will book it at 30. I'm just making a very simple income statement, and we are saying that the selling price, let's assume it to be 40, which is going to be same for both the cases. My FIFO firm will make a profit only of 3, while my LIFO firm will make a profit of 10. So here is where a LIFO firm is going to show all this hidden profit being getting into the books, which is your P&L or income statement. Now, when would this happen? When it shall sell this unit of inventory which has been understated so far. Now the question is, this particular phenomena might not exist till liquidation of the firm. I had taken a hypothetical case where we are selling this point, because generally if you would see that the quantity purchased is generally more than quantity sold. If not, if quantity purchased is less than quantity sold, some portion of opening stock also gets to be sold, and that's exactly where my next point of liquidation of LIFO reserve comes into picture. By liquidation, I mean lowering down or falling off this amount of 7 or 5. Let's jump on to the consequential topic of LIFO liquidation, which basically means reduction in the value of LIFO reserve. For simplicity's sake, I have taken a very similar example, and I am making two cases out of it. My LIFO reserve can go down because of two aspects. One, when the prices again fall, so which means that after a year of inflation there is deflation. Or the second reason, which is more important reason, is when the quantity of inventory is falling, which is exactly what I was discussing a little while ago. When the quantity of inventory is falling, which means that the opening stock quantity is lower than the closing stock quantity. Okay, so here let's just go ahead with the first case, and let's just look at this example. Again, 0 opening stock, first purchase is at 30, second purchase is at 35. I have assumed 1 unit. The first sale happens, so this 30 comes here, this 35 comes here. There is an understatement of profit by 5, which is hidden in the inventory, and the LIFO reserve balance comes up. So if you look at it, the delta is plus 5. But in the next year, you would see that the third purchase, this is the third purchase, which is again happening at $30. So the purchase price, if you would see, from 30 moved up to 35, has again come back to 30. So the prices are falling in the second year, as a result of which you would see that there is a delta negative 5 in LIFO reserve. Okay, now keeping that in mind, you would see that a 0 to plus 5 has again become 0. There are two things to it. One, as an accountant, what do you do? And as an analyst, what are you supposed to do? Well, as an accountant, you got to learn this phenomena and see that when and why this delta falls. And as an analyst, you got to do nothing about it. I'm going to talk about the same aspect in few moments from now. No adjustment is required because it is something which is outside the control of the firm. Let's just talk about a more important case, which is the second case, wherein we say that the prices are not falling. If you look at the prices from 30 to 35, there has been an inflation, and in the second year I haven't increased the price. I've kept it at a similar value just to show it as ceteris paribus. Now here I have made the example little complicated. Rather than assuming one unit of each, I have taken different unit because here the quantity needs to be very carefully noted. I want all the viewers to please have a calculator in their hands and practice the equation simultaneously. Now, first of all, forget about LIFO reserve. I want you to very carefully note down the figures, which is the basic application of FIFO and LIFO. So again, for simplicity's sake, I have assumed the first year to be starting with 0 inventory. First purchase 10 unit of 30, which is $300, 5 units of 35, 175, and the next year the third purchase is of 8 unit for 35, which is 280. Now applying first in first out, if I make a sale of 11 unit, entire 10 units from this is going to go out, so this is 300, and 1 unit which will come out from this second purchase of 35, so overall it becomes 335. The 4 units that I would have in my stock would be of 35, which is the second purchase, which is right here. Okay, so this is what is my opening and closing balance of respective years. In the next year, I've purchased 8 unit, which we talked about, 280. Second sale also, I have kept it at 11 unit just to keep, both these years, apple to apple. And therein we are saying that out of 11, 4 units will come from this opening stock, and remaining 7 will come out of the third purchase at 35. So the total figure is 385, keeping the 1 unit at $35. LIFO, on the other hand, we have the last in first out. So keeping that in mind, all 175, the second purchase has been sold out. 6 units was be from the first purchase, so keeping at 30, 6 into 30, 180, so 355 is the value, and remaining 120 here. In last in first out, you would recall that the inventory is always priced at the initial most value, which is 30 here. So 1 unit which is remaining is at 30, and respective is the calculation for COGS. Now if you look at it, the LIFO reserve balance from 0 to 20 has again gone down to 5. Let me give you a example or a formula for LIFO reserve, which is the quantity in the closing stock multiplied by difference in the price. That means my LIFO reserve has become a derivative of two aspects: A, change in quantity, and B, change in price. Case 1 that we have talked about was price was falling, so therefore if this delta falls, then also the LIFO reserve will fall. While the case 2 that we are doing here is fall in the quantity, where the closing stock is going to be lower than the opening stock. That will also lead to the LIFO reserve. So if you look at it, at the end of the first year, the inventory balance is 4, and the difference in the price between 30 and 35 is 5. So therefore total 20 is the value for LIFO reserve. However, at the end of the second year, while the difference still remains 5, the change in price hasn't happened, and that's why I had kept 35 to 35, so that I wanted to highlight this difference. The change in price hasn't happened. The only thing is that the quantity from 4 has become equal to 1. So overall my LIFO reserve has become equal to 5, which is right here. Now 1, again, like I talked about, is what you do as an accountant, is the same calculation and understanding part of it, and the other one, what do you do as an analyst. Sometimes if the quantity falls, it may be because of the manipulated intent to show a lower COGS in case of the LIFO firm. The firm, for any reason, might want to show a higher profit and therefore want to liquidate its inventory lying in the opening stock. That may be artificial. So the point here is that due to inclusion of cheap inventory, which is the opening inventory, which is right at the opening prices, the COGS LIFO gets understated and leading to higher artificial profit. To be very honest, this might happen intentionally or non-intentionally as well. As an analyst, in either case, you have to increase the COGS of LIFO, which is this figure of 370 calculated by an accountant for all your ratios. You will have to increase it by the fall in the LIFO reserve, because this fall is being perceived as manipulative. So if someone asks you to calculate inventory turnover, you got to use COGS as 385, not at 370. So this particular example talks about the real LIFO liquidation, which happens when the quantity, here falls down. So just to quickly summarize it up, this is really the formula that you have to memorize and understand, that LIFO reserve is quantity lying in the stock, closing stock, multiplied by the change in the price during the year. If the price change is huge, then the value of LIFO reserve would also be huge. LIFO reserve per se doesn't come into the balance sheet nor in the income statement, but is shown just as footnotes by all the firms which are following LIFO, obviously in the US. The important aspect here is that whenever the quantity falls, which means the closing stock is lower than the opening stock, which is a case where the sale is more than the purchase, there we talk about LIFO liquidation might be manipulative, as a result of which analysts need to do something, which is to increase the original COGS, understated COGS, by this amount of 15. So I hope that the current session was useful. Should you have any query, write to us at query@finstudyclub.com. I look forward to speak to you in my forthcoming tutorials. Thank you very much.